what do investors do in today's real estate market? I guess before we even go through this first article, just I guess what's the state of real estate investors need to know about?
The state of real estate is inflation. The battle has not been won. So we know the Federal Reserve is going to keep interest rates higher for longer. As an investor, what does that mean for us? It means cash flow is going to be down, and we have to buy better deals and put together better deals with better terms. Period. End of discussion. What's happening then is the total number of real estate transactions is down. But let's flip over to the investor side. The investor transaction count is actually down more than the traditional real estate market. That's really where we're at. So if you are in the investor pipeline right now and hunting for deals, I need you to negotiate stronger. I need you to get better pricing. I need you to get better terms with longer closings and more protections. Ignore 20, 21, and 22 and the beginning of 23. Everything you did in those is out the window. I need you thinking like a 2014 and 15 investor right now. Here's what I mean. The economy was just starting to improve when that was happening, but there wasn't an investor everywhere. There wasn't a bidding war on everything, and there was still deals. That's where we're at today. And we've said this before. You can go check all of our previous episodes. We've told you this winter is the time to buy and negotiate. Please go get a deal. Every indication is showing that that is the facts. So there's your investor market. It's not going to change for a while. So expect the investor market to be very good in 2024 because you have the election. Rates will still be higher. They're going to try to force up unemployment. Therefore, there's still going to be deals available.
Boom. Should be investing. Actually, on that note, just out of curiosity, before we jump into this Redfin article, just for shits and giggles, is it better to go after luxury homes right now or maybe the average home if you're an investor and if you had to choose one or the other to get a deal?
We've been an investor for 20 years in the greater Seattle metro. It doesn't matter to me what kind of market it is. I can always get a deal. Okay, so that question doesn't mean much to me personally, just to be honest. But here was the lens I would always filter anything through. What is my 5, 10, 20, 30, 50 legacy goals? What's my criteria by which I buy? What do I have the most intimate market knowledge about? So the thing to understand about real estate investing is that intimate market knowledge turns into deals. So if you have intimate market knowledge about the luxury market, you can probably get a better deal there versus anyone else. If you have intimate market knowledge about industrial real estate, you'll probably get a better deal regardless of the market. So you need to go learn and study what you're going to invest in. Now, from just sheer raw numbers, you're probably going to get your best deal on an ultra luxury home. Second is going to be an office building. Third is going to be a large multifamily. Large, I'm talking like 50 units and above, especially if that multifamily was just purchased or finished construction in the last 3 years. Most of the bridge debt that was put out there, bridge debt is floating debt. So they're doing a value add or they're finishing some type of construction, is going to have to refinance over the next couple of years. So that big multifamily space is going to get beat up. Now, flip it over. Where do most people play and where do most people have money to play? It's going to be in the single family game, in the flipping of a home, in the building of a single family house, manufactured home. That's where most people are going to be able to financially play when they're getting started. So I'm going to recommend go to where you have intimate market knowledge. If you don't have the money, go get someone else's money, or go start wherever you can, which may be building a home, flipping a home, because the vast majority of investment is actually going to happen in the single family space. In the Seattle metro and throughout most of the United States, we're behind on new construction. So I am so hot on flipping, building, and developing right now. I have not been this hot on this since 2005. I mean, it's like the winds are they're pointed in the perfect direction. The sails are full. Like, it's run that pirate ship at 100 knots. Let's rock and roll, because everyone's getting out of the way. When markets are tight, the small and medium investor goes away. But that creates opportunity for those who are willing to go play. So if you are a small and medium investor or a large investor, had some phenomenal conversations with large investors, right? It's playtime. You need to brush up on your negotiation skills. You need to brush up on your data and analytics skills. You need to know the market intimately, and then you need to go make offers like crazy. And it's okay. Go make 20 of them. We made an offer last week, a piece of vacant land, listed at $250,000. We make an offer for $200,000. That's a $50,000 price drop. That's 22% or 25% off, somewhere right in there. That's a big amount off. They counter back giving us 15 off, but they say we have to close 3 days after feasibility. We go, nope. And they go, well, aren't you going to counter? No, you didn't come close enough to our terms. Late this week, we'll make the same offer again. Here's my offer. Does it look better in week number 2? Oh, it doesn't? No worries. Week number 3, I'm going to come back. Hey, here's my offer again. What we're going to keep doing is we're going to keep making these offers with very similar terms until we get an offer that is acceptable to us, that has enough margin of safety and enough profit in it just in case the market corrects more or the Fed raises interest rates more and destabilizes the economy. You need to create that margin of safety in terms that protect you. You have to do that today.
I love it. It's more nuanced than just black and white, this or that, which is pretty obvious. But I know that is a question people ask. Should I go for it? Because they're seeing those crazy discounts on luxury homes. And then I know that with the average home, there's a lot of competition for it. And I know that we're going to be talking about flipping a little bit later. But let's just start with more generally, again, kind of like the state of real estate. Redfin just put out this article, and the headline was real estate investors pull back, buying 45% fewer homes than a year ago. Can you break this down? Tell us what this means. Is it just like a clickbaity headline, or is there something that we should be, seeing in this article?
When you see a headline and it says investors pull back and they're buying 45% fewer homes than a year ago, you should be thanking God. You should say, thank you, God, you blessed me with a recession. The average investor has a small window, a short mindset, and a short view. The true investor has a long time horizon, and they know wealth is created when less people are buying. So this article should make you giddy inside. You should get little goosebumps all over your arm, and you should be going, oh my goodness, this is a buy signal. It's go time, because wealth is created during these times. So Warren Buffett, let's quote him again. Be fearful when others are greedy, and greedy when others are fearful. What Warren is saying to you is he's saying now is the time. So the average market only went down like 31%, and the investor market went down more. Traditionally speaking, if you go back through time and you look at the investor market and you start to graph it out, and in this Redfin article, they did graph it out from 2000 moving forward. And when do you think investor purchases bottomed during the Great Recession?
They bottomed, I want to say in 2009 or 10.
Dude, you're nailing it. They bottomed basically, and the graph is kind of looking like, but they bottomed somewhere in like 10, 11, 12.
That's when the prices were best too.
That's when the prices were best too. So wait a second. The amount of investors purchasing was the lowest when the opportunity was the highest. It's because most investors fall victim to herd mentality and they simply follow the news. They need to listen to your creator video that you made about how to guard your mind from the social media algorithms, because we got to do that on the investor side and guard our mind, because when you see they're purchasing almost 50% less, that should be, your mind should say back here in the lizard brain, it should go, wait a second. If they're buying 50% less homes, that's a buy signal for the real investor. So this is a buy signal for the real investor right now. Metros where investor market share dropped the most: Phoenix, Las Vegas, and Atlanta. Okay, so flip that around. If investors bought less homes in Phoenix, Las Vegas, and Atlanta, And this is Redfin looking at all these metros. Where could possibly some of the best deals happen over the next 24 months?
Atlanta.
And Phoenix and Las Vegas. I mean, we need to call our homies that live in these places and say, boys, it's time to go buy. Part of the reason was it was those iBuyers, the hedge funds. They were pulling out of those areas. We need to throw this one out there so everyone's on the same page. Hedge funds and investors were purchasing 20%. 1 in 5 of the homes sold in 2022 in the beginning. That's an astronomical number, okay? Hedge funds for 2023, let's talk about like Invitation Homes as the example. Invitation Homes would be a net seller this year if they hadn't picked up the block of homes from Starwood. And Starwood was having massive financial trouble, so they had to liquidate, I don't know, it was like 3,000 homes, and Invitation picked them up. If they hadn't bought that block of homes from Starwood, they'd be a net negative seller. So realize on an overall basis, the hedge funds are out right now too. So if big money is out, small investors are scared, big investors are scared, and the numbers are hitting that 50% mark, it should be the go signal. If you're not ready to go, get your income ready, get your credit ready, get your Dear Aunt Tilly ready. Okay? If you are ready to go, start making offers with the best terms you have ever written that are biased towards you in the last 7 years now. And keep making those offers until you get one that works.
Aunt Tilly, I'm definitely going to call her. So one question I have for you, I think about this all the time because I worked through it as a professional in real estate when I was an agent. But I think about all the people that just had a really bad experience during the Great Recession.
Yes.
And it's reflecting in people's fear right now. So the investors dropping out happened post crash. The crash was 2007 or 2008,
yep.
Right? That was when the major crash happened in the stock market, on the news front, and then generally, and then that was the beginning of the recession, and prices just kind of dropped to about 2009. It's still so fresh in people's minds,
yes.
Especially if you got hit hard. My theory, and I want you to correct me if I'm wrong, is investors are almost preemptively
yes.
bailing. They're like, I don't want to be that first. I don't want to be the one of the crowd that loses everything. I'm just going to pull my money out of the system or whatever. So they are almost creating the opportunity for the wiser investor, the more sound investor, the one that's thinking long term. Am I right in thinking that? Because I've never talked to someone else. I just know because of my experience as well, that I'm like, let me just kind of see what everybody else does.
Well, first off, I personally have PTSD from last recession too. When, hey babe, we're out of money. Oh, by the way, we owe everyone money. Yeah, we're negative, in the 7-digit realm. Oh, P.S., all of our lines of credit have been called. We might have to file bankruptcy. Oh, by the way, we're pregnant with our second child. Oh, here's your humble card. Here's your man card. Oh, crap. She's like, my pregnant wife has to go work for my father-in-law in the restaurant again. Okay, so I have a little bit of PTSD from that. That's one of the things that's prevented me from building my next house immediately. I worry about that. So I know what the buyer is feeling. I know what the investor is feeling. And when you look through the data, though, here's what generally happens, and this is why you should follow multiple data sets. You got to follow new construction. Generally speaking, new construction starts declining. The total number of permits goes down. The total number of new construction homes going into construction, so the start of construction starts going down. Then the new construction sales stop. Then the new construction prices go down. See, because the reason you should follow builders in your local market, I recommend what you should do is you should create a spreadsheet, and you put on the spreadsheet the builders in your city. You put how many listings they have active, how many they have pending, how many they're selling, the average days on market, and the average price per square foot of the actives, the pendings, the solds, and just graph it out over time. If you see that active price start to go below the pending price, and that pending price now start to scoop below the sold, it's pull the parachute, get out, we have a problem, mayday. What's actually happening right now throughout all the US is that new construction is making up double the percentage of the market it's usually making up. And builders are pushing in harder. The reason you watch a builder is a builder doesn't have one home to sell. They have 10, 20, 30, 50, 500. So a builder will react to the local market conditions faster than any other seller in any market. Also, people like D.R. Horton, Pulte, Toll Brothers, LGI, pick your builder. Do they have a lot of brilliant people that work for them? Do they have big money Wall Street behind them? Can they get debt cheaper than anyone else? Major economists that work for them. Can they pick up the phone and call Morgan Stanley and say, Morgan Stanley, what's happening here? And they'll get the insider scoop. That's things we don't have. So we can follow the big money. But the big money right now on that builder side, what they are doing is they're going in. So when they're going in, follow them, but watch them closely because each local market's different. The Seattle Metro, we're hot on this right now. But if your local market is showing that and all of a sudden that active price is dropping or the builder starts offering a bunch of incentives, interest rate buy downs, closing costs, free car, you know they've got to unload inventory. That's the indicator the market is changing. So like we've talked about previously, you need to understand your local market, the local signals, because we're talking about it in the Seattle Metro and on a national level, but your local market may be different. And the builder is going to show you exactly what's happening. So because the builders in our area are go, we're go. What's interesting too, Redfin, this data. The metros where investor market share increased the most, these 5 metros. Number 1 with the biggest increase was New York City. Next comes our hometown, Seattle. It was up from to 11%. Third, Cleveland. 4th, Chicago. Number 5, Riverside, California. So when you look at these these metros, and these 5 are increasing, well, the rest of them have been decreasing. It should also tell you, well, these are good ones to play in too. There's a wave to ride up. One thing that you always need to be, okay, in a market like this, where the economy is not 100%, where the job market's not 100%, where interest rates are high, you have to be over-cautiously optimistic. You have to have greater reserves than you would normally have. You have to have extra cash. You've got to be making better deals. You have to protect you, yourself, your family more in these markets. If you're not getting a deal without those protections, don't do the deal. That's the secret, because you should never risk it all on one deal. If it has the threat of complete and utter ruin, if this deal would sink you and your family for 20 years, never do that deal. Go find a smaller deal that if you lost, it would be survivable and you could recover. The secret is doing base hits consistently, sustained over a long period of time, uninterrupted, not trying to hit a home run.
Man, I feel like we just went through so many of our points in our notes. So basically what you're saying is, I mean, people like Warren Buffett, everybody wants to be a billionaire like him, yep. Right? His secret was he started investing 20, 30, 40, 50 years ago. This is your opportunity to do it. And yeah, it's interesting to think back of that season when everybody lost so much, right? I mean, like almost everybody like had that experience, either losing a job or their business slowed down. They either, had to do something with their bank to do a short sell or negotiate foreclosure. It was just a really hard time. And again, it's just so fresh in our brains. It's affecting not only what people are doing, but what people are posting. That's another thing too, like just social media and YouTube. We didn't really have it to this degree in 2008, 9, and 10. Like YouTube was not used for real estate information yet. No. So it's interesting just to think about that.
Let's think about that for a second. So what's happening is, because you've been doing YouTube for a long time, you coach creators. Do positive titles and thumbnails get clicks, or do negative titles and thumbnails get clicks?
100%. The fearful mind loves those negative clickbait titles.
So that's on YouTube. But that's also true for all the rest of the social media platforms and for the media. So realize the media is pushing a negative narrative. So we have to guard our mind, guard our heart, and know our local market better than they do, so we can make financial decisions in our local market that'll benefit us. This is where that knowledge is power, and that knowledge and power actually turns into money. And keep studying it until you know it.
Yeah, on the flip side of that, though, and we're going to get into flipping houses here in a second, but in real estate, when there's those super positive headlines, that's when everybody jumps in.
Bingo.
Right? So it is interesting, the opposite side of it. If people like, of course, I just made, $300,000 on my Airbnb or whatever. I refinanced out, made money, and I got like cash flow going on. And it's like, you can sign up for my course. Like that also happens on the flip side.
Yes.
But it's probably even more important because during those times, there's so much competition. Yes, there's profit to be made, but there's also a lot of profit to be lost, or just you could get into a really bad spot. Versus the negative times, because so many people are hesitant and fearful, there's these opportunities that people aren't seeing. And if you're the one that sees it when no one else does, man, that is a really powerful position to be in, because you'll have way more leverage as well, because there's less people making offers on those houses, on those deals.
Brilliant, dude. Brilliant. Let's flip this around. If I'm an investor who is investing for the long term, I pray for markets like this, because a market like this that's beat up, that's not perfect, with high interest rates, with low volume, with just a lot of structural problems inside, what it's going to do is it's going to take my skill level and shove it through the roof. And as it shoves my skill level through the roof, that's going to then pay me over the next 20, 30, 50 years. So for the person who's just getting started, this is the best market to get started in. For the hardcore investor, they're already smiling. So I went and met with some very large, hardcore local investors. And I said, what do you guys want to do right now? And they said, we want to buy and we want to double our holdings. I said, oh my goodness, like you want to double your holdings? And they said, we want to double our holdings over the next 36 months. Whoa, okay. Why do you feel this way? Well, we feel right now is the opportunity and the time. So someone with a lot of experience feels that right now is the time to do that. And you should be hearing that, once again, whether you're new to doing this or experienced and going, wait a second. Someone with a very large portfolio is saying go. It means it's go time. If you're feeling something different, that's okay. Tell us what you're feeling in the comments, or leave questions in the comments about this too. We'll do a follow-up video or answer your questions, because I want to know what you're specifically seeing, because we're talking about the Seattle Metro and the national level. But what are you seeing locally? And then how is that affecting you? And what questions do you have about your market or just about investing in general that we can answer?
Can we move to flipping? Because I know a lot of investors, they want to get into the flipping game. And so my question is, flipping, is it a good time? What should you be looking out for? And one of the things I brought up is from this website. There's an article, and the headline is "Flipping the Script: Home Flipping Activity Drops as Profits Rise." So that's very interesting to me. Let's talk about that. But kind of the quick version of this: the typical transaction's gross profit, the difference between the median purchase price investors paid and the median resale price, increased to $66,000 in the second quarter. That's still down 35% from $102,000 in the second quarter of 2022, and one of the lowest points in the last 5 years. But it's up from $56,000 in the first quarter, meaning there seems to be this upward projection of profits, even if there is less flipping activity. So, back to the question, what's your advice for investors that want to get into flipping? Is it the right time? And what are you looking for? What are you doing?
Is it the right time to get into flipping? I think it is. I think this is one of those market opportunities that only happens once in a while. We have structural pressure right now. Inflation is high, interest rates are high, so you've got that locked in seller who's not selling. So there's a lack of inventory. Builders are increasing on their side. So if you're going to go flip, right now is the time to do it. If you look at 2020, 21, 22, the market got so hot that anyone would overpay for a flip. So your margins on a flip were going down, and we became very negative on the flipping process because we were not getting the margins we were looking for. If you made margins the whole time, I want to know in the comments, and then also tell me what city that you're in specifically. But what's happening is we know from like that Redfin article, for example, that investors are down 45% in their purchasing. And part of those investors are people who are home flippers. So if less people are making offers on beat up properties to rehab them, that means simple supply and demand. There's less demand on the same amount of supply of homes that need to be rehabbed. Therefore, you can get them at a lower price. So you're getting them at a lower price, and you're getting, therefore, an increase in profit. It's a cool little teeter-totter. Is less people are doing it, so profits are going up. And because of this lack of inventory, there's going to be massive opportunity. Build a home, do a development project, flip a house. Now, people get really caught up in this flipping of a house and get, how should I do it? What should I be looking at? What's my exit strategy? And they worry about a lot of these details. You can contact us via the link above and ask us questions about this, or we can go hunt for an off-market deal. But the reality is there's a really simple thing. You need an ARV, the as repaired value of the property, minus the cost of the sale, minus the cost of the money, minus the cost of the repairs. Here's the important one, minus my profit, which should be somewhere between 10 to 15% of the ARV, the as repaired value. In a market like this, I'd recommend hitting the 15, equals what I offer. There is your flipping formula. Now, I flipped it. What's the problem with flipping?
Well, it costs money, it takes time, and you might run into some headaches.
Oh, yes. Love it. Problems with flipping. There are unknowns, and sooner or later a flip will bite you. You will open a wall in a kitchen, and you'll realize the whole back wall of the kitchen is rotted, and that's an $18,000 fix, and this is a true story.
Better, rat's nest.
Yes, rat's nest. Oh, are you talking about the property that we did that had
so many?
Yeah, unforeseen pest problems, unforeseen water problems. So sooner or later, you're going to get bit by a flip, number one. Number two, they require a lot of cash. They're capital intensive, or they require hard money, which is expensive. Number three, flipping is a short-term event with the highest tax implications possible. So every time you flip a home, you are paying the most amount in taxes that you would for anything. So there's two things I want to recommend. I want you to have the strategy to flip the home, and then part of it is to flip it, part of it is to keep it, and the third bonus strategy is maybe I should just wholesale it and kick it to another investor. I want to dig into the third strategy for just a second here. See, if you're really good at finding the properties, and you could make 60 grand flipping it, but I could make 15 grand giving this to another investor in 2 weeks, and it's going to take me 90 days to make the 60 grand or 120 days, which one should I do? You should probably wholesale that deal to another investor and then just go find a better deal where maybe you're going to make 90. Because I can wholesale it quicker than I can flip them. And there's only so many flips. Because flipping also, there's a lot of moving parts. And so there's a lot of brain power that goes into flipping something and a lot of emotional energy that goes into flipping something. Flip it, keep it as a hold, wholesale it. That's what you should be thinking about every time you look at a flip project. Fourth tip, super bonus tip. Can I build an ADU in the backyard? Can I subdivide the lot? Could I get a permit to turn this into a duplex? Could I rezone this and turned into a commercial piece of property. That one you need to dig deeper into, and we've got videos that go into that. But you need to be looking at this more than one way. The mistake the investors make is they put these blinders on, and they're only looking at one way forward. And you should have a checklist with every project that you go through. Flip it, keep it, wholesale it, burr it, bring in an outside investor, create an owner financed note on it, subdivide it, build an ADU, whatever. But you should, every time you pull a property in, take 30 minutes of quiet time to create multiple strategies.
Yeah, the ADU is such a good piece of advice. And by the way, that's additional dwelling unit. So it's like a mother-in-law apartment or a garage with a 1 bedroom on top of it, because lack of inventory, lack of housing, more specifically, lack of affordable housing. Almost all of America is experiencing this. So rather than trying to go big and do a development or even build a house, somebody right down the street from here built a little garage that easily could have been an ADU.
Yep.
And a lot less work. Also, arguably, a lot less pressure. And I mean, it's still building a house, so you have to get permits and do it all the right ways. But you'd be surprised, because there's a lot of people that probably could never afford a house right now, unfortunately.
Yep. But
they could probably afford a 1 bedroom or a studio type of apartment, right? It wouldn't be called an apartment. And a lot of counties, a lot of places in America are allowing ADUs because of this problem. So it's a solution that you could bring to the table. Any thoughts on that? Because I know you find a lot of properties where the ADU solution is, gonna almost double your profits when you flip a property.
the baby boomer demographics are forcing things like ADUs and DADUs to happen more. The affordability problem in the United States is also forcing ADUs, DADUs, duplexes, tiny houses to happen more. The zoning regulation problem in the United States is forcing ADUs, DADUs to happen more because it's the only way to deliver affordable product. Now, if you're one of our investors on our list, you get access to these things. So I'm going to give you an exact example. So we put a property under contract, and this property is under contract for $490,000. It is worth $535,000, and it will allow a duplex DADU, detached accessory dwelling unit, so a 2-unit in the backyard. So I said to one of our investors, because when our plate gets full, we just start handing out deals to our homies. Oh, you're a homie, we'll get a deal. You're a homie, you get a deal. And so I said to one of our investors, I was very straight up about it. I was like, I got this thing under contract for $490,000. I was like, I'm gonna give it to you for $20,000. Okay, so you're gonna be into it $510,000, and it's worth $535,000. And he goes, well, dude, that's a smoking deal. I was like, yeah, then I'm going to show you how to build a duplex in the backyard, and you're going to make a home run because I know you want to grow up to be a developer. And I've got this little project set up for you that is simple, that doesn't have a ton of risk. This is the whole thing. Investors always want to go take the hugest risks ever. Just go take a little risk, learn it, and keep taking those little risks until you have enough capital, enough cash flow to maybe be able to take one of those big risks.
On that note, this is a little bonus tip on ADUs. And speaking of boomers, typically those houses that that generation has are on lots that are a lot bigger.
Yeah.
Just go into any town, any city that's older than 30 or 40 years. The section that is from the 40s, 50s, 60s, and 70s, those lots sometimes are 3 and 4 times bigger than the new lots. I know this because I'm in one of those new lots that I barely have a backyard, right? I couldn't entertain people. Versus I went to my homeboy's house, and he has enough room to literally throw a party for like 100 people. And guess what that is? That's room for the ADU. So that's something that's interesting. It literally just popped into my mind thinking about these people retiring, moving off, maybe going to retirement homes. And those properties have huge backyards, sometimes huge front and side yards.
Yep.
There's one I'm eyeing right now, actually, that you could build a whole nother house, subdivide it, and like have 2 houses for one.
I love it. And we will, because the baby boomer demographic is aging and they're hitting that retirement phase right now, you're going to see more and more of these creative solutions. You're going to see happening in all municipalities, but really here in the Seattle Metro, I mean, we are getting ADUs and DADUs pushed like crazy. Plus, we had the middle housing bill passed. So you're going to see a lot more of that infill duplex, fourplex, sixplex stuff. So that the ADUs, DADUs, and the duplex to sixplex is going to become extremely prevalent here throughout the Seattle Metro. And I know we're not the only metro that's really pushing on this stuff right now. So the reality is, you know, just to kind of pull it back full circle, it's a great time to flip a house, but realize you are in the highest tax bracket when you do, and you're doing something capital intensive, and it's emotional. So I want you to create multiple exit strategies and multiple strategies to be able to do this. That way you've created your margin of safety to protect you and allow you to go do it again. You need a system that is replicatable and scalable and repeatable by a non-PhD, okay? By literally simple, skilled labor. If your system is too complex and it's not replicatable and not scalable and not leverageable, you'll go do it once. In my mind, we're hardcore investors. We would do it once to build the model, and then we build the model to go do it 100, 1,000 times.
Okay, on that note, I want you to land the plane here. My first question before we do, though, is how does somebody become your homie to get these deals? You were saying, hey, I hand out deals to homies. How do they become a homie?
Yeah, very simple. If you're on YouTube, you can click on the link or you can send us an email. We have a list. It's just literally a large Excel spreadsheet, and part of it's inside of our database of investors that are looking for certain criteria. And so we batch those investors out based on certain criteria. And then when we have deals that come in those spaces, what we do is we connect them with the type of deal that they are specifically looking for. So you can sign up via the link or you can send us an email.
Are there better options for investing in real estate beyond flipping and ADUs? What are some other things that people might want to consider, especially if you have a bigger bank account?
There are so many ways to invest in real estate. And one of the quickest, simplest ways for someone to invest in real estate is what people call house hacking. Go live in your primary residence. And in an ideal world, your primary residence would be like a duplex, and you'd rent out part of it. And then 6 months, a year later, 2 years later, you'd move out, go buy another duplex, rent the other side, do it again. You can own or occupy between 1 to 4 units. Let's say you only qualify for a single family. That's fine. Go buy the single family, live in the single family, move out, do it again. That's one of the quickest ways to start to acquire a bunch of units. The second thing that people should be considering is basically, how do I burr it? Buy it, rehab it, rent it, refinance it, keep it. Now, let's say you didn't hit a home run on the burr and you weren't able to get all of your cash back. Okay. The idea is that you would be able to create a 75% equity spread, so 75% loan to value. So then you could go get an investor loan and get all the cash back. But let's say you only create a 15% spread. Well, I'm still only 10% into a house versus 25, which would allow me to do another deal or two with the same amount of cash. Also, this is something I don't like that's come out because of, Instagram, TikTok, YouTube. The buy and hold is sexy. It's really sexy. Whoever said the buy and hold wasn't sexy can't do math. It's cool. Buy a house. Hold it for 30 years. Let someone else pay it off. You have a free and clear asset. There's nothing wrong with that. It's sexy. Just do it, okay? Next. I love land. Go buy a piece of land. Get the land ready. Build a house on it.
God's not making more of it.
The dirt bank, God's assets, land. You should always be trying to look at how to do that. Generally speaking, you're going to be able to build equity in the land development, anywhere between 10 to 20%. And that's on the land side. And then on the structure side, when you build the structure, you're going to build in at least another 5 to 15%. Well, if I did that correct, I've built in my 25 to 30% down payment, and I can essentially burr it. But the beauty of it, when I build it and burr it, or do a big boy burr, like we like to call them, is that I got a brand new construction, and I didn't rehab a home from the 60s, that's 60 years old right now. Because it doesn't matter how much I rehab it, it's never going to be perfect and up to today's construction standards. So I'd rather have it take a little bit longer and end up with a brand new product that's less maintenance, that's built better over time. Another strategy a lot of people they neglect to consider. We mentioned Dear Aunt Tilly earlier. Dear Aunt Tilly is the made-up fictitious person in your life that may or may not be related to you, who has extra money, who would invest with you because they know, like, love, and trust you. That's who Dear Aunt Tilly is. And we don't do enough of working with our network to increase our net worth. Because you should go grab 5 of your friends and go buy a property together. That's totally fine, especially if you have specific market expertise. Now, another level of that is what's called a real estate syndication. You could become a part of a real estate syndication where you just hand an investor money and you become what's called the limited partner. The investor who runs the show is the general partner, and they're going to give you some type of a return. Do you have to qualify for the mortgage? Nope. Did you have to swing a hammer? Nope. Did someone else get dirty on the weekends while you did it? Yep. So a syndication can be a phenomenal vehicle that people get involved with. Okay. Another thing, they could also get involved in a real estate fund. A fund is similar to a syndication, but what it is it's a pool of money to go buy a specific set of assets. A real estate syndication is generally for one asset specifically. Last but not least, you could loan money on real estate. See, a lot of people, they look at that one as like they don't even think about it. It's not even on their list.
It's for the banks.
It's for the banks. I want you to be the bank, Benji. Why shouldn't you be, JP Morgan? Okay.
Charge 8% right now. 7% a deal. It's good for you.
7 would be a deal. I mean, you're going to charge 8, 9, 10, and 2 points on top of that. That's a great return. Okay, so lending money, I think a lot of people should definitely consider. These are better options that are beyond just flipping. That don't get me wrong. I like flipping. I think it's a good market to flip in, but I think you have to have multiple strategies when we go into something like this.
And you have to have an Anton to tell you how to do it.
You have to find an agent in your local market who understands the data, what makes the market tick, and how to hunt down a deal. In addition to that, if you're going to be a hardcore investor yourself, you need to learn those 3 things yourself. You need to know the local market, know the local data, understand what affects it. Let me give you an example. In our area, Boeing is a major employer. If Boeing lost a bunch of contracts, that would affect our local economy. So who's the major employer in your city that you need to follow what they're doing because it would affect the local economy? What's the legislation that's happening on the state level, the county level, and the city level that's going to affect the value of properties here? For example, the Cascade Industrial Park up here in North Snohomish County. It's 1,500 acres. When I was a kid, it was swampy farmland. Today, it's selling for millions an acre. And, Amazon just went in there. Tesla's going in there. All this big stuff's going in there. Well, that was, if you understood the legislation and the zoning and the push by the city of Marysville and the city of Arlington to get that to happen in that area, if you simply would have bought farmland there just 10 years ago, you could have paid $300,000 for it. And you literally would have sold it for like $5 million. That happened in a 10-year run. So local politics, local employers, and then on the national stage, inflation, interest rates, total unemployment, the stock market, the bond market. That's what's affecting where things are headed.
Even if you're a young person or you're a beginner agent, especially in this season when people are pulling out and people are fearful, those more I'd say like on the outskirt deals, literally like on the outskirts of town, definitely people aren't looking at it. So that plot of land that's eventually going to be a Walmart, you know, in 10 or 20 years, those are the deals right now that somebody's going to get. Hopefully it's you. If you call Anton, you probably want that deal though. You want that Walmart land deal, right?
But we can't buy them all. That's the thing to always understand. We always have more deals than we have capital for. That's part of being a good hardcore agent. And I want to give this is like the bonus tip for everyone listening. You need to go to your local city and your county, and you need to go look at their long-term comprehensive planning. Where do they want growth to head to? Where are they projecting it? That's where you're going to know, oh, I'm going to put a Walmart here in the future. Oh, this is going to become industrial, or oh, this might become multifamily, and I can buy it as the cheap farmland today.
Boom. All right. So investors, call Anton, and we'll see you next week.